Good afternoon, everyone, and welcome back to the Peterson Institute for International Economics. I'm Adam Posen, the Institute's president, and we're here today for the book launch for Fiscal Policy Under Low Interest Rates, which our colleague Olivier Blanchard has just published with MIT Press. Now, many of you, particularly those of you tuning in or with us live today in Washington, know that this has been quite the journey over the last few years. Olivier gave his now very famous, deservedly famous, AEA presidential address on the topic of fiscal policy under low interest rates and highlighting the magic R minus G calculation some 4 years ago. In the time since, we've had COVID. We've had huge budget swings to contend with COVID. We've had interest rates go down. We've had interest rates go up. We've had interest rates move sideways. We have had very large scale fiscal stimulus, some Olivier approved of and some of which Olivier didn't entirely approve of. We have had changes in government. And so some people might be out there saying fiscal policy under low interest rates, what's that about? That day is gone. As Olivier will explain, that day has been with us for a long time, and it is quite unlikely to be gone, although the inflationary episode we are currently living in is an interruption. And then that brings us back to the fundamental analysis that Olivier Blanchard made about fiscal policy, particularly in advanced economies, large economies. But if Olivier is right, low interest rates decrease not only the fiscal costs of debt, but also the welfare costs of debt. And that is, I think, the fundamental message to take away. And if low interest rates remain and we have monetary policy near the effective lower bound in terms of interest rate policy, then the benefits of stabilization policy from the fiscal side become even more important. This is still a message that is an important rethink and policy guide, as well as a financial rethink for markets around the world. Olivier Blanchard has been with us as the the inaugural Fred Bergsten Senior Fellow here at the Peterson Institute since 2015. Prior to that, he served as the Economic Counselor and Director of the Research Department at the International Monetary Fund from 2008 to 2015 throughout the global financial crisis. He has been as well, he remains the Robert M. Solow Professor of Economics Emeritus at MIT. He is a major player in French political and economic debate. Last year, the Blanchard-Tirole Commission on Challenges for the 21st Century Economy for France came out. I was proud to be one of the commissioners on that report, but Olivier and Jean were, of course, the intellectual wellsprings. He and our former colleague, now Director of Bruegel, recently co-authored a piece, German Zettelmeyer, co-authored a piece on fiscal rules in Europe that has proven quite influential in broadening out the Commission's changed rules. But today he is here to talk about his long-term new understanding of fiscal policy and explain why the insights he put on paper in 2019 remain valid today and beyond. Thank you, Olivier.
Good. Adam, first, thank you for the kind words, and thank you to all of us for having taken the time to come and listen to me. Let me just plunge into the topic at hand. This is the graph which really triggered the work that I've done on the topic for the last 10 years, as Adam has explained. And it's a very striking graph. It's the graph of 10-year real rates, ex-ante real rates in the US, Eurozone, Japan, since 1992. And the message is a fairly obvious one. This is constructed by taking 10-year nominal rates on government bonds and subtracting 10-year forecasts of inflation. And the message is very clear, which is that they have fairly steadily and commonly decreased from a level of 4, around 4, to a level around 0 or -1. And there are two things to note. The first one is that it's not just some events which created the fall. And you can, if you look carefully, you'll find the global financial crisis, but it's not what triggered it. It's clearly deep forces at work. And then the commonality. You know, Japan went through it first, and we thought, okay, well, Japan is special, and then basically Europe and the US did follow. Just one remark, I could have made the graph even more striking by starting in, say, 1985. The reason I didn't do it is that this is a period in which there was a disinflation at play, and the interest rate had increased a lot in order to fight inflation. And so clearly this was unusually high interest rates. And I started in 1992 because by then inflation rates were under control. So this was, I would say, the main motivation for thinking what this implied about policy, about the world. This I discovered later, but I've been very struck by, and many of you may have seen it. It's a graph which has been constructed incredibly carefully by Paul Schmersing, who is at Harvard, who went back to safe rates all the way to the early 1300s. Now, this means finding contracts where the rate is relatively safe, so it starts with the Venetians and so on and so on. It's not the same contracts over time, but he has done, I think, an extremely careful job. Now, clearly, what you don't have when you want to know about the real rates in 1325 is the ex-ante real rates, because at the time, surprisingly, they didn't publish 10-year ahead inflation forecasts. So these are exposed rates. But you know, for the type of frequency we care about in this graph, it doesn't make much difference. And again, it is very striking. What we're seeing is faster than the historical decline, but it is clearly on top of a historical decline of major magnitude. So again, these graphs led me to think about implications. And when I wrote the book, the interest rates were low. And, you know, things looked that were going my way. But we are now in 2023. And the question is, well, is this a nice book about the history of the last 30 years, which historians will enjoy, maybe, or is it something about the future? And I'm in a way happy that I'm coming out now, because clearly the question is in the mind of people. And I really believe that we're going to go back to a state of low real rates and probably real rates below growth rates, which is what has been defined as secular stagnation. I think that's where we're going. Now, I realize I have a co-author, Jean Tirole, that was mentioned by Adam, who has written a lot on motivated beliefs, which is when you really have pushed something in the past, the way you look at the future is biased by your desire to actually not be wrong. I think there is more than that. I think that I'm going to try to convince you that I have a reasonable argument for believing this. So the first thing is, yeah, rates are high because of the fight against inflation. And clearly central banks have to increase the rate in order to slow down activity. But even today, if you look at actually the rates that we are seeing today, they are amazingly low by historical standards, and they still basically reflect a negative R minus G. So here, these are numbers that many of you probably look at every day. The current US 10-year rate is 3.4 actually today, but 3.5 on the screen. The US 10-year forecast of inflation I take the CBO, which may not be the best, but it's the only 10-year forecast I know. It's 2.4%, so it gives a real rate of, on the screen, 1.1%. If you were to do it today, 1%. If you take the forecast of growth, and again, you can take various sources, it is lower than in the past. The CBO forecast has 1.7%. So this still gives an R minus G of minus 0.6%. So we're still in the negative R minus G mode even today. Now, these 10-year rates include various things that you'd like to clear out, which is initially the rates are going to be higher because of the fight against disinflation. And then you have QE at the long end, which might be distorting the 10-year rates. So what I give you in the last line of this is basically what you can get from the OIS curve and the inflation swaps. And I thank Enya for helping me to get these numbers. But basically the 1-year real rate, 10 years out, is at this stage minus the CBO growth forecast for that year is minus 1.2%. So markets basically expect to return to a negative R minus G. Now, the next line is going to make some people unhappy in the room, but we cannot trust fully investors. And therefore, we have to go deeper. And I think that's where my argument becomes more convincing. We have to look at the fundamentals behind the decline in R minus G in the past. We have to understand what they were and how they are going to evolve over the future. And that's, I think, the important slide. So, borrowing from a chapter in the book, how do we think about this evolution of the rate decreasing over time? First, we're thinking not of the actual rate, but the neutral rate. It's clear that there are deviations of the actual from the neutral rate. The neutral rate being a rate which is needed to maintain demand at full employment, if you want. Okay. And so when we think about it this way, then it depends clearly on the supply of funds, the demand of funds, saving and investment. And given that we're looking at safe rates, which for the most part are the rates that are paid on government bonds in advanced economies, the demand for safety. So these are the three elements which you need to organize your thoughts about why there has been a decline. And there has been a large number of papers on the topic. Why did rates go down? I don't think we've identified exactly which ones were the most relevant in the exact proportions, but I think we have a good sense of what has happened. And pre-COVID, I think the general agreement, and I still think it's the right one, is that what we had was strong saving, weak investment, and a strong demand for safe assets or for demand for safety. Right? On saving, why is it? To me, it's two things. It's demographics. So the increase in life expectancy leads, if a retirement age doesn't increase 1-for-1, to a larger, longer retirement age. So people need to save more over their lifetime in order to have enough in retirement. And so this actually increases saving. The other argument, the other factor which I think is very important is, in a way, trivial, but not always mentioned, which is the level of income. If you have a country where income is low and most people live hand to mouth, they don't save. As income increases, either for part of the population or for the country as a whole, then more and more people are able to save a bit. Precautionary saving, life cycle saving. So as income increases, then the saving rate actually increases. That's not standard theory, but I think it's actually right. So I think that explains what happened to saving, both in the, the 800 years and the more recent 35 years. Investment, this has been, as you know, a period in advanced economies in which TFP growth has been disappointing. And as a result, investment has been disappointing. So weak investment, strong saving. This means a low equilibrium rate of return on capital, right? And so that gives you the first part, I think, of the explanation. But the rate of return on capital is a risky rate. If you want to think of it as a marginal product of capital, it's risky. Or if you want to think about the return on equity, it's risky. Now, what we're looking at here is the safe rate. And so there's a difference between the two, which is called either the equity premium or the safety discount, one being the negative of the other, and that depends on the demand for safe assets. And I think there is no ambiguity about the fact that in the period we've seen, there has been an increased demand for safe assets. Came from different places. For example, China, which was saving a lot and contributing to large saving in the world, saved mostly in the form of reserves, which is very safe. But it's more general than that. We had regulation forcing financial institutions to hold liquid assets, and they have. If you believe that uncertainty has increased, then precautionary saving may also have led to more demand for safe assets. So I think these are the factors. Again, I wish we knew exactly which one did what, but we don't. But looking forward, I don't see any strong inversion in each of these factors turning around and implying a much larger increase in interest rate. In saving, if you think it's increased life expectancy and higher income, that will continue. So it doesn't seem as if we can expect much change. Now, there's an argument made by my still friend, despite what he said, Larry, who said that the increase in debt that we've had during COVID is leading, and he's correct about the sign, is leading to a higher equilibrium rate. He's right about the sign. I think he's wrong about the magnitude. And I think that number is very striking, which is if you look at advanced economies and you look at the debt ratio from 2019, so pre-COVID to the end of last year, the increase in the debt to GDP ratio has been 7%. Now, this may surprise you given the size of the deficits we had, but the fact is that inflation and relatively low nominal rates took away a lot of the debt. The result is that there hasn't been a very large increase in debt as a result of COVID and the various measures which have been taken. So yes, it is not negligible, but I don't think it changes the picture in a fundamental way. Demand for safety, third argument, I see no reason to think that, that there's going to be less regulation and uncertainty surely is, if anything, higher than it used to be. So I don't see a change. The third one, and so that's the reason I've inverted the presentation of the three, is where I think there is uncertainty, which is investment has been weak. And the question is, does it continue? And here, we really don't know. Right? Sometimes TFP growth can just explode. It's very hard to predict from one decade to the next. And then investment could be much bigger. So if you think that AI is going to lead to enormous TFP growth and investment, then you might think that R star, the neutral rate, will be higher. If we did everything we need to do for green investment in order to meet the goals of COP21, that would lead to a substantial increase in investment. And that, again, would lead to an increase in R star. I don't think it would change the sign, but it would clearly make a difference. So here there is uncertainty. And to the extent that governments do what they need to do on green investment, then I think that R minus G will be less negative, might even get positive for all I know. But that would be very good news. So if I lose on my forecast because of that, I'll be very happy. So the point of this, and I spent a lot of time on this because it is clearly the question on the mind of many people, and the title of the book is provocative in a way, is I think that we're going to be in this mode for quite a while. Maybe not as negative R minus G, but something not far. Okay, so having done this, let me just give you a sense of the rest of the book. Okay, the argument, the basic argument of the book was actually given by Adam. The first three lines I've talked about, we're going to be, I think, likely in an R minus G negative environment. And so this has three implications. The first two, lower fiscal cost of deficits and debt, that's just debt arithmetic. When you pay less on interest, then the debt dynamics are more favorable. The second is lower welfare costs of debt and deficits. And these two kind of are a pair. The third one comes from the additional assumption that we may be facing, again, what what was known as the ZLB, the zero lower bound, which we now call the effective lower bound because we know we can go a bit negative. And if you start with low real rates, low target inflation, then you have low nominal rates. And if there is a slowdown in demand, then as we've seen, the central banks cannot decrease the rate enough. They cannot decrease R down to what R star is. And so in this case, what this implies is more limits on monetary policy and therefore more need for fiscal policy as a stabilization tool. Conceptually, it's a different argument from the first two. And it can be repaired by having higher target inflation, for example, which would give more room to monetary policy. But the combination of all this is what happens. So the conclusion is smaller costs and larger benefits of debt and deficits, and the need for a more active role for fiscal policy. Although I think the need for a more active role for fiscal policy is wider than just that. I think there are many reasons to think that we don't use it enough for stabilization purposes. As I said in the last line, this is really a book about advanced economies. We have to be much more careful. I think the general principle apply, but emerging market economies are facing higher rates, more uncertainty, and so on. So one has to be careful. Okay, let me give you a sense of the structure of the book. It has 5 chapters. So the first one is basic concepts, and I don't think that's needed in this room. What's a neutral rate? What's the difference between safe and risky rates? What's the effective lower bound? Maybe the important point is that this way of thinking leads to 2 thresholds. The first one is when R star, the neutral rate minus G, becomes negative. So when R is sufficiently low that this changes sign. And then a much lower threshold, which is when the effective lower bound starts being binding. So the first one, R star less than G, just requires that R be less than G. So maybe if G is 2%, less than 2%. The second one basically comes only when basically the central banks are stuck at 0. And if inflation is, say, 2%, then it happens at minus 2%. So you cross the first one much sooner than you cross the second one. Okay. The next line, I'm not sure I need to do here or discuss here. Some people say, oh, but these low rates are the results of central banks, and it was completely stupid and they should stop. Central banks try desperately to keep R equal to R star, or another way of saying this. They try to keep the economy at full employment. And so when R star decreases, for fundamental reasons, the central bank tries to basically go along. They are not responsible for the low R's. Okay, the chapter 2 basically I've talked about the evolution of rates. I've explained what the 3 factors I see are. And then the meat of the book is in the last 3 chapters. Over chapter 3 is about the fiscal costs of that, so debt sustainability, fiscal space, if you want. And it starts from the very surprising debt dynamics when R minus G is negative. It's a big kind of an Alice in Wonderland environment in which things are very different. And the question is it relevant or not? I'll come back to it. Chapter 4 is about the welfare cost. And that goes back to the issue of dynamic inefficiency and the golden rule. So it's a relatively abstract, but it has been argued that when R is less than G, that is good. It's good for welfare, having more debt. And the question is this relevant in the world in which we are? And we'll say not completely, but there's something to be learned. And then chapter 5 says, okay, so you've presented all these arguments, what do you do in practice? And it looks at fiscal policy in action, looking at the excess consolidation during the euro crisis in Europe, the excess fiscal expansion in the US under Biden administration, and then the fascinating case of Japan. So I'm going to run you through various of these points to give you kind of a spirit, at least, of what these chapters do. So fiscal cost of debt, it's really arithmetic, right? It basically, you write down the debt dynamics and you look at what happens when R minus G is negative. So the debt dynamics is the first equation that is there, that you all know. D is the debt to GDP ratio. So the change in the debt to GDP ratio depends on R minus G times the debt to GDP ratio last time minus the primary surplus, S. Okay. Why is R minus G there? Because all things equal, if debt pays interest, it goes up at rate R, but you're dividing by GDP, which is increasing at rate G. And so the ratio of the two moves according to R minus G. That's why this is so important. And so debt to GDP stabilization, you just put the left-hand side at zero. And then you get that stabilization implies that you run a primary balance, S equal to R minus G times the debt to GDP ratio. Now, in the textbook, R minus G is positive, so if you have debt, you have to have a surplus, you have to find taxes somewhere, right? But if R minus G is negative, you actually don't need to run a surplus in order to keep the debt to GDP constant. So you have, put it formally, you have much more fiscal space. So there are various ways of talking about this. The first two, I've given you three ways. The first two are provocative. The first is, suppose we have a deficit once, so we increase that, and then we never raise taxes again. Well, that will go back, debt to GDP will go back to the old level. There is never a need to increase taxes. So the notion that debt today implies higher taxes in the future is wrong. The second is you can actually run any primary deficit, so you have a negative, and that will not explode. It will increase, but it will not explode. I think the third one, the relevant one, which is that in an environment like this, you can run a primary deficit, not too large, but you can run some primary deficit and keep the debt to GDP constant. So you don't need to be obsessed by generating a primary surplus. Okay, so that's what you do to start. But you say, okay, so where are we? R minus G is negative. Is all this really for real? And no, the answer is no. There's no infinite fiscal space for two reasons. The first one is as you start doing this, as you increase that, then you put pressure on the interest rate, on the neutral rate. So at some stage, R becomes positive, greater than G. You have to stop. And the other is uncertainty, which is all this is fine if you know exactly what's going to happen. But suppose R increases a lot, what do you do? So the next slide is basically about implications of this way of thinking. And what I argue is that the way to think about debt sustainability is that it is not a 0-1 proposition as opposed to the way it's sometimes described. It's a probabilistic statement about the probability that there is an issue with that sustainability at some point. And so in that context, uncertainty is of the essence. You could have a path in which an expected value is just fine, but there's a chance. So the right tool, I've argued, and that's the work I've done with Jerome in particular, Jerome is Dettelmeyer, is that we need basically to think about the evolution of debt over time, taking into account expectations, but also uncertainty. So the tool which is used for that is stochastic debt sustainability analysis. Okay. So the stochastic part is to take into account the uncertainty about everything, about R, about G, about implicit liabilities, and so on. And we have pushed this way of assessing whether that is sustainable or not. And to my great pleasure, surprise and pleasure, the EU Commission has come out with a proposal which is very much along these lines. I can elaborate on how it's done, and they put more structure than I've described, but the conceptual approach is, I think, the right one. And clearly, when R is lower, then there is a smaller probability that that will not be sustainable. There has been, given time, I'm going to skip the next part of the slide, which is, if you really want a rule, should you make it contingent on some debt number or some debt service number? And the logic of the equation is debt service. That's what the cost of debt is. But the problem with that is that debt service can be incredibly uncertain, because basically if you have 100% debt and the interest rate goes from 1 to 2%, then you suddenly have to double interest payments. It's a very large time. So this is something to be discussed. I think, again, Larry and Jason have pushed for this, but I think it has to be used very carefully. Let me move on. And so, welfare cost of debt. And this is the part which is both, in a way, most abstract, but also maybe most relevant, which is the part which is difficult to explain to non-economists, but is really important. So a traditional view of debt is that if people save in the form of debt, then they are going to save less in the form of capital. Therefore, there's going to be less capital in the future that displaces capital, and therefore less output in the future, and therefore future generations will pay. There are other aspects to it, which is redistribution across generations, but that's a cost for the economy as a whole. And when R minus G is negative, then that no longer follows. So in theoretical models, you have two extremely important contributions, the one by Phelps and then the work by Peter Diamond. What Phelps showed is that if R is less than G, then there's actually too much capital. R is a signal, the low R is a signal that capital is really not productive enough, right? And I equal to G equal the golden rule, but if you have more than that, you basically have too much capital. It's like you're carrying an enormous amount of capital, which you have to replace depreciation for, you have to increase because there is growth and therefore your capital must increase. You're not making enough in terms of marginal product. And so that's a fairly fundamental point. When you're there, basically you can decrease investment, increase consumption today, and increase consumption in the future. That's the world of dynamic inefficiency. And what Peter Diamond showed is that, well, that can do the job, basically. If you're in that world, R is less than G, you issue debt, that's going to displace capital. That's a very good thing because there was too much. And he shows that it can be done. So the question is, are we in that world? Should we love that? And it's clear that the models are fairly abstract, but also they do not allow for uncertainty and for the fact that we have many interest rates, safe rates, but we have a return on equity, we have a return on various assets. And clearly, for example, the return on equity is greater most of the time than the rate of growth. So which rate should we choose? So that was the subject of my presidential lecture at PIIE. And basically what I showed is, well, there's a very strong intuition for why the safe rate is the right way to look at. And let me try to, actually, I thought this morning I should try to convince you of that by thinking about the following thing, which is suppose that we do a transfer in which we take one from the young and we give one to the old. So basically, as an individual, you're going to give up one now and get one later. So ignore growth. So it's a completely safe transfer across, right? So the alternative is instead of that, I can actually hold capital, right? Rate of return on capital is probably higher on average than one, but that's not what I care about because the first one is safe, right? It's one for one, safe, no question. So I want to do the risk-adjusted rate of return on capital and compare this to the alternative. Well, the risk-adjusted rate of return on capital is the safe rate. And therefore, that's the comparison I need to do. So it turns out that that carries fairly far when you do the modeling. In the end, there are general equilibrium implications so that bottom line, and I'm not going to bother you with equations, basically the right weight in judging whether we're on one side or the other is some combination of the safe rate and the average marginal product. So we're probably not in the crazy world in which debt is literally good, but we're in a world in which debt is probably not bad from a welfare point of view. I think that's a robust conclusion. Right? So these were the first two. The next one is welfare benefits of deficit. And here, basically, I've made the point, which is if monetary policy cannot be used because it is already at the zero lower bound, then you have to use fiscal policy in order to sustain output. That's desirable, and you should do it. Then there is a discussion, which I'm going to pass on, whether fiscal policy actually does the job. when you reduce taxes or increase spending, does it actually increase output? That's a whole discussion about multipliers, which is a whole separate discussion. But I would argue that yes, in effect, that's what happens, and you can use fiscal policy for that. Okay. So, trying to put things together. Way I like to think about it is that there are two different views of optimal fiscal policy, budgetary policy rather than fiscal. Fiscal is about the combination of taxes. But the first one is what I would call, and is called, the pure public finance view. So it says stabilization is an issue, but monetary policy takes care of it. And therefore, we as public finance people can ignore the stabilization role of fiscal, give it to the central banks, they do the job, and then we focus on the rest. So in this case, it becomes, when do you have that? When you run deficits, and you know the answers, basically. If you have a very large amount of spending, which is not going to last, you want to smooth taxes to reduce distortions. If you want to help current generations or future generations, you can use debt to transfer. So these are very traditional arguments, and they are relevant, for example, in the case of green investment. Okay. And what you're going to do is going to depend on R star. Right? If R star is very low, then the cost, for example, of smoothing taxes is very low. At the same time, they are going to affect R star. If you decide for some reason that you want more debt, then R star is going to be higher. So you have to solve for that. Now, if at the end, when you've done all this, and R star is fine and it's high enough, then you're done. The problem is, suppose you do all this and R star is low. Then you cannot say, oh, but monetary policy will do the job, because a very low R star with low target inflation means that the room for monetary policy to help is very limited. So you go to, conceptually, to the other extreme, which is that you start using fiscal policy not only for what I've talked about, but also for fiscal stabilization. So when R star is very close to, or is too low, basically, to give enough room to monetary policy, then you have to start using fiscal policy in order to maintain output. That way of thinking about it, which is fiscal policy as stabilization, also has a name. It's called pure functional finance, and it was introduced by Abba Lerner. He did it not for the same reason, or he argued not for the same reason, but this was a time when there was extreme skepticism about whether interest rates affected demand, whether monetary policy could be used. If you were in a world in which you didn't believe in monetary policy, then you had to use fiscal policy, and it was about that. Here, the argument is a bit different, but the result is the same. Now, what are you going to want to do? Well, it's going to be a mix of the two. Sometimes, maybe, you can do mostly the first. Sometimes you really have to do much more the second. So, issues which I'm not going to talk about, but I talk about in the book. And then, if I have 3 more minutes, I will finish with that slide. So, the book develops a way of thinking about things and things which could be done. And then I applied to 3 events. So the first one, I'm only going to talk about the third one, which I think is still going and absolutely fascinating. So the first one is, there is no question that during the euro crisis, the shift to debt consolidation is much too fast. They basically ignored the fact that monetary policy could not help. It was at the $0 bound, and it was very strong. And it led to not a large recession, because the recession had been earlier, but a very slow recovery, with not much gain in terms of that reduction. So I see this as a mistake. The second is mistake in the opposite direction, which is when COVID came, it made sense to have transfers to the people who are most affected, and it was a good idea. The Biden administration put in place a package, but I thought the package was about 3 times too large and was just so much more than was needed, and it would lead to pressure, overheating, inflation, and unfortunately, I've turned out to be right. The third one is the interesting one. Because in a way, the Japanese have done what I suggest countries do, right? They have been subject to depressed demand for a very long time, and they have decided to decrease interest rates to zero, or actually a bit negative, and run deficits in order to sustain demand. It's more complicated than that. I don't think they fully understood what they were doing at the beginning, but that's what they have done. But now they have a debt to GDP ratio net of 170% and growth of 250. The question is, well, that's a bit of an issue. Or is it an issue? So there are two discussions. The first one is the main one. The second one is less visible, I think more important, which is what if R star, the equilibrium, the neutral rate increases, forcing the central bank, the BOJ, to increase R, because when you multiply 172% by an increase of 1%, that's nearly 2% of GDP you have to find somewhere. So the answer is, I think it depends very much on the source of why the interest rate will increase. So if it's a sudden stop, which we think is unlikely in Japan because of the domestic composition of holdings, but suppose that investors became very worried for no good reason, then I think that that's not an issue. I think the BOJ has shown that if there is no change in fundamentals, they'll basically go in and buy. They already have bought about 50% of the bonds, and they would buy more. And if there is really nothing behind it, then they'll do it. So I don't think that's a big issue. I mean, that's worrisome, but not worse. The second is, suppose that by chance, domestic private demand becomes stronger. So Japan gets rid of its old weak private demand problem. But that's actually a self-solving one, because as demand does this, that basically allows fiscal policy to be a bit tighter, right? Demand is stronger, private demand is stronger, and therefore this allows the state to actually decrease the deficit. So in a way, it solves itself. It's not the end of the world. What happens if the rest of the world increases R, as we're seeing now, whether it's an increase in R star or just an increase in R because of a fight against inflation? Well, then Japan has this option, which it has used to a large extent, which is to depreciate, not increase their own R, and just let the yen depreciate. And they have done this to a large extent, and they have increased rates a bit, but there has been depreciation. So I don't think it's dramatic. I mean, it's clearly complex when you start with such debt to GDP ratios, but not dramatic. I think the big question is, suppose that they continue to be in the same rut, that basically private demand remains very low. The BOJ has to stay at zero. Maybe has to continue to do yield curve control. Deficits are needed in order to sustain demand, and that continues to increase. Well, that's an issue, because at some point it's clear that it becomes too big, even for somebody like me. When you get to 300%, I start worrying. And so the question is, are there ways of increasing private demand without basically running large fiscal deficits? And, I don't have any magic solutions, but there's still some social insurance which can be provided. This would decrease precautionary saving. And they could do public green investment, even if they finance it for taxes. This is likely to actually increase demand on that. But these are the things they have to think about, and these are the things we may have to think about in our own countries as time goes. This was fast, too fast, but that gives you a sense of what I've tried to do in the book.
Thank you. Yes. Thank you, Olivier. Again, the launch today is of the book Fiscal Policy Under Low Interest Rates, just published by MIT Press, created and edited here at the Peterson Institute by Olivier Blanchard. As you said, you covered a lot of ground with your usual concision and clarity. Before opening it up to the floor, I was wondering if I could ask a couple questions. The whole spirit of your, or content even, of your book is on the real side. There are movements in real rates, they're simultaneous across countries. It's R minus G, it's not I minus Y or whatever nominal variable you want. But especially nowadays, we have a recurrence of people who think that there is a very tight tie between fiscal excess and inflation. You mentioned it in the overheating context, but I'm thinking more of fiscal theory of the price level people, Cochrane, Woodford, people like that. So is there a worry for Japan or for US that as your debt level goes up, you have a nominal problem, even if you don't have a debt sustainability problem? Or is that only if you overheat in the short term, like you said Biden did?
So, yeah, if you buy the fiscal theory of the price level by John Cochrane, then there is a relation between the price level and expected future deficits. And so there, the logic of the argument is indeed, if we're going to run large deficits, then this is going to lead to a high price level, not necessarily high inflation, by the way, but high price level, because people are forward-looking. The person who is in charge of a price level is a really smart person who actually looks at the fiscal balances over the next 20 years and then sets the price level personally at the level at which it has to be in order to make the debt sustainable. I find this utterly irrelevant because,
Just to be clear, that was irrelevant. Yes, sorry.
yes, because that seems, and that's a discussion I've had with John Cochrane. It seems to me that the price level is exactly the opposite of an asset price. It is basically the results of billions of individual price decisions taken by people who couldn't care less about the fiscal deficit, don't know what it is, right? And are backward looking, typically, they just like to cover cost, right? And so this notion that the price level anticipates in a serious way the fiscal deficits of the future seems wrong. Footnote, I think there's an environment in which John becomes slightly less wrong, which is hyperinflation. Because initially, when you set your price today, you think about cost. When you get to an environment of 50% inflation or 100% inflation, then you think about something very different, which is I want to get rid of my money. And then basically you think much more about, well, what's going to happen to inflation, right? And I try to get rid of the money. And therefore, then you start thinking about why is inflation going up? Money stock seems to be exploding. That probably comes from fiscal policy. And then I think for hyperinflation, John's model is probably closer to the right one. But I think it is of zero relevance to the environment in which we are.
So another
I hope I was subtle enough.
we would reward subtlety here, as you know. So perhaps even less subtle question. You know, you motivate, as you put it, even that you started thinking in this direction because of the chart you throw up of the 35 years of declining rates or the 600 years of declining rates, depending which chart. What to me, one of the things that's most striking, particularly for the last 35 years, is how much G7 essentially moves in tandem. So this gets us into a broader question.
Like G and R?
Well, the G7 rates move in tandem. G. Yeah, sorry, not capital G, not little g. Anyway,
big G.
Big G. And it's interesting to me to juxtapose this with your work on fiscal rules, because in a sense, this seems to say some very fundamental things. It's totally irrelevant what your fiscal institutions are, right? So US, Europe, Japan, they have different budget rules, they have different budget processes, they have different shares of government shares of GDP, but basically our star is moving the same way for all of them, and that's the major factor here. So just a little bit more about where you see differences in institutions or fiscal rules fitting into your framework, or are they, like the fiscal theory of the price level, irrelevant?
Yeah. So it is striking how much the G7 have moved in tandem, except maybe Japan started.
Yeah.
But in general, I mean, this graph is striking.
Right.
And I could have added the UK, I could have added. So what this says is clearly the determination of our star is global, right? You can think of, okay, this country's saving is higher, therefore it may play a role, but it's clear that the markets are very much integrated. At the same time, I think fiscal specificities play an important role in each country because you don't get R star if you're not seen as safe, right? And so, Italy is integrated, but because of the sins of the past, they have to pay, 100 basis points more. So again, I think it leads to a common safe rate, but not everybody gets it, right? And the countries, as we know, many countries cannot borrow at the safe rate. I mean, even within the advanced economies, but even more so when you look at emerging markets. So I think that's the way in which the country idiosyncrasies matter.
Yeah, the premium over the safe rate. So just building on that, you and our current colleague, Arvind Subramanian, did a policy brief for the Institute a couple of years back, trying to see when and how much this framework applies to emerging markets and lower middle income economies. You had your one bullet line, but what's been striking is in recent years, a number of EM, including India and Brazil, large EM, but EM seem to have had more fiscal and monetary space than they've had in previous Fed tightening cycles or times of trouble. So could you say a bit more about if you're advising an EM, a developing country, when do they get to start living in Olivier land and not in Cochrane land?
I think there are two reasons why a number of emerging markets have done better. The first is that the safe rate is lower, so whatever spread they have to pay over the safe spread, the safe rate means that they pay a lower rate. So I think that's one, but it is very clear, and I think this is a discussion I had with Arvind. If you think in terms of this stochastic debt sustainability analysis, that the first moments could be the same, the expected values could be the same for an advanced economy and a less advanced one, but the uncertainty is going to be much, much, much larger. We used to think it was mostly for political reasons. We're now a bit more doubtful that there's such a difference between the two types of countries, but it's still the case that that's going to imply that you're not quite sure what the next government is going to do, whether it's not going to default on the debt. So I think, the methodology is the same, but you're going to have to be much more careful. So if you find that 100% debt to GDP is fine for a country like France, say, you might find that the same methodology applied to Brazil tells you 60% is the right number. It seems to me that, but again, I think the main difference is uncertainty, both about the specific environment. I mean, if you're an exporter of primary commodities, you face a lot of uncertainty. But in addition, the internal politics may not be as reliable as elsewhere.
Picking up on that point about uncertainty, after your presidential address and some of your subsequent publications, various people, market people, but also academics, raised that they felt your argument was too sanguine about jumps in interest rates or the possibility of jumps in the interest rate and what that might do. And in your discussion of Japan, which admittedly had to be very curt, you talk about BOJ can handle. Our friends Peter Orszag, Robert Rubin, and Joe Stiglitz published with us a brief paper in which they argued that they were much more worried about uncertainty and jumps in the interest rate, not just in terms of sudden stops. Now, just to motivate this, we saw in the UK just a couple months ago a G7 economy have interest rates shoot up overnight. So is this uninteresting? This is just, okay, they're creating a new premium over the safe rate. Does this affect your policy recommendations, concern about jumps in the interest rate? Or, I mean, how should we think about it since people seem to be very unsettled by that aspect of your argument?
I think uncertainty comes largely from the behavior, uncertainty about the behavior of a government.
Right.
The way I read the evidence, and for example, the way rating agencies have reacted to the increase in debt over that period, is that they think that there is fiscal space. So when the governments decided to have fairly large subsidies for COVID to protect people from COVID or to protect people later, I think the markets did not penalize them very much because they thought, okay, so this is kind of one-off. Otherwise, they look responsible. I think as soon as you present something which is more worrisome, in which for some crazy reason you believe Arthur Laffer,
Right.
or you basically indicate that you really don't give a damn about deficits, then they kill you. And I think that's what we saw. So what I have recommended to my own government is to have, for the time being, a regular budget and a crisis budget, with the idea that on the regular budget, there has to be steady adjustment, if demand allows it, but steady adjustment, showing that you really want to decrease that. But a separate crisis budget saying, well, if there's a crisis, we're just going to spend money. We can do it. It's needed, but it's not permanent. It's basically. Now, the danger with this is there can be many crises. And maybe at some point that separation doesn't become credible anymore. But it seems to me that, the French Minister of Finance should say, we are committed to slowly reduce the debt to GDP ratio at a rate where monetary policy can help and go faster, right? But, if we have to spend 1 or 2% of GDP next year in order to avoid people suffering from something, we'll do it. And again, I don't know whether there's enough credibility at this point to get away with that language, but that's what I would try.
A final question, then I'll open up to the audience for a minute. You and I have talked recurrently through many years about Japan. And you mentioned in a lighthearted way that 300% of GDP, debt to GDP ratio is a little much even for you. So you just summarized your advice for the French finance minister. If you were giving advice today to the Japanese finance minister, is it any different?
Yeah, I think they are much closer to where I would not like them to be. And so I think the challenge is the last line of the slide, which is, can we find ways of basically increasing our star in Japan, moving private demand up without relying on fiscal deficits? And, I've suggested 2 ways. I'm not sure that they can do the trick, but I think at this stage, the priority in Japan should be to continue what they're doing now, but think really hard about whether there are alternatives which do not lead that to GDP to keep increasing. If I knew the solution, I would offer myself as Minister of Finance of Japan, but I don't.
Fair enough. This meeting is on the record. It's being live webcast and also will be available on the Peterson Institute website. We have a live microphone in the hands of Jessica Parada. We have a microphone in the middle of the room. Would any of our in-person audience like to ask a question or make a comment at this time? Paolo, if you could identify yourself, please.
Paolo Mauro, IMF. Thank you very much. 2 quick questions. The first one is, historically, a negative R minus G is the norm. Yet, we do see defaults. So how does one think about that? The second question is, unlike R minus G, a 0 nominal interest rate is an aberration. It only happened for a very short number of years recently. Do you think that's going to come back?
So these are two good questions. And we've discussed them before, actually. So in my presidential address, I made that point, that R minus G was often negative. But I concluded that it was typically for different reasons from the R minus G negative that we now have, or we had just before COVID. It basically reflected either a monetary policy mistake. So for example, the lack of reaction to the increase in prices in the 70s, price of energy, which led to very large ex post and even ex ante interest rates, so monetary policy mistakes. And the second was fiscal dominance, which is that in a number of cases, the states would say, you keep interest rates low and inflation is higher. I think what we saw here is none of that. So it seems to me that's a different environment. Now, you're right that there is a risk. I mean, again, the political economy considerations are important. And when you tell governments, well, with R minus G, you can be more relaxed. There is being relaxed and being very relaxed. And I think what you've shown in your work is that basically when R minus G is smaller, you don't see much improvement in the debt to GDP ratio because governments basically spend more. So here I'm playing my role as an academic, as somebody from the outside saying there is more space. I think there are enough caveats, along the way, but I realize that it could be misused. But again, I don't think that the historical evidence on R minus G is directly relevant to the kind of discussion we have. On whether we're going to hit the zero lower bound again, that's your point. Well, what was special pre-COVID, which made us hit it for decades? And you're right that hitting the zero lower bound means that we need an R star of -2%, -3%, which is a very, very low number. So, but we got it, right? And as you'll remember, all the studies of the optimal target inflation rate assumed that it would never happen, or it would happen with very small probability. It has happened much more. So I have to believe that it can happen again. Again, it's a much tougher threshold than the R minus G negative, but we've hit it consistently. And the question is, why not again? What was special about the past? And I don't see anything very special.
Thank you. Another question from the floor? Going once? Yeah, please go to the mic there if you would.
David Orden from Virginia Tech. If I could get you to comment on the U.S. situation just for a minute. Last night on the PBS NewsHour, there was a chart put up showing that we're at about 100% of GDP debt now, and the projection is to go close to 200%. So leaving aside the question of whether, if you didn't want that debt to increase, you would raise taxes or lower spending, that's one issue. Should we be concerned in this current heated debate we're about to have about the debt limit, should we be concerned about that rising projected debt level? Or is that something that you think the U.S. economy, given your perceptions, your understanding, could handle if that turns out to be the case?
So I have not done the stochastic debt sustainability analysis for the US, but I've looked at the CBO numbers very carefully. And although I think they are pessimistic, it is a case that I think we are on an unsustainable trajectory in the US. I have no doubt that we have to basically reduce deficits in the US more than is currently in play. So I think the US is not in trouble. It's trouble if they don't change policies. They'll change policies. But the current trajectory based on the current rules worries me very much. So I think this answers the first part of your question. The second part about the debt limit, I don't have any major insight. I mean, it's theater. We know that it will be solved in some way. Whether it's solved in a way which is useful and needs this administration and the next ones to be more careful about deficits. I do not know whether it's going to be, again, I think it's theater, but theater can be scary, but I think it's theater. But behind this, there is a serious issue, which is that I think that trajectory of the US is not sustainable under existing policies.
On that cheery note, I will bring this meeting to a close. This was the launch of Olivier Blanchard's new book, Fiscal Policy Under Low Interest Rates, available pretty much anywhere from MIT Press, written and edited here at the Peterson Institute. And I would like to thank our dear distinguished colleague, Olivier. Thank you very much.